Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week we'll have a look at a pretty strange development, and that is very low levels of volatility across the globe, despite what is still a very uncertain economic backdrop. We'll also have a look at the minutes from the last Fed meeting and the results of the Jackson Hole conference, and finally we'll have a look at inflation in South Africa. We're going to start off with volatility. The economic backdrop is pretty uncertain. There's little clarity with regards to where tariffs are going to be in 6 months' time in the US. There's little clarity with regards to where growth is going to be, where inflation is going to be, and what the interest rate response is going to be. But despite all of this uncertainty, we've seen a pretty steep drop-off in volatility across markets across the globe. As an example, in the US, the last time that there was a 2% daily move in the US market was back in May. And if you look at 60-day volatility, that's now currently sitting at about 9%. The 20-year average is 14%. So we're looking at below average levels of volatility by a couple of measures in the US and across the globe, despite what is still a pretty uncertain economic backdrop. And that by itself is fairly unusual. And it's not just equity volatility that's declined. Fixed income volatility, as measured by the MOVE index in the US, has declined too. And if one looks at expected volatility for currencies, that's also declined. So we've seen this broad-based decline in volatility across asset classes, across countries, in an environment where uncertainty is elevated. So where we sit at the moment is that the VIX, the best measure of market uncertainty, market fear, is sitting at about 14. The low for that series, going back about 30 years, is 9. So there's not much downside to that series. The series is skewed. On many occasions, you'll see the VIX sitting at that sort of 10 to 15 level, but it can get much higher than that. And for our purposes, what that means, we do need to be a bit cautious here. It does appear that the market is quite relaxed. There seems to be a sanguine approach. There's limited downside to the VIX and the measure of uncertainty. There's quite a bit of upside if the market does become a bit more concerned and takes into consideration all of the uncertainty that we're currently facing. And the risk there is that whenever the VIX goes up, it's typically the case that the US market goes down. And similarly, when the VIX goes down, the US market goes up. Now, this is a short-term measure. This is measured on daily returns. But what it does tell us in the back of our mind is that we do need to be aware of a potential asymmetry. As the market potentially becomes more concerned around the economic backdrop, that would be a headwind for equities. And there's limited scope for the market becoming less concerned, given where the VIX is at the moment. Just touching on some of the indicators that suggest one should be concerned. If you look at the leading indicator as an example, it came out last week. It's still down year on year. It is still pointing to a potential slowdown in the US. And there are a couple of other series that we look at too that suggest that the US economy is slow. For example, if you look at hotel occupancy in the US, the year-to-date average is the lowest we've seen in 25 years outside of recessions or COVID. So there are clearly signs of some form of deterioration in economic activity in the US, and we could add to that the non-farm payrolls numbers, the latest ones, which saw a big revision down. Those non-farm payrolls numbers did come out post the last FOMC meeting. So when one looks at the minutes for the last Fed meeting, one does need to be cognizant of the fact that the environment they were looking at that point has shifted quite materially. But it's quite clear from the last minutes that the Fed at that time was concerned about both inflation potentially increasing and the economic environment deteriorating. And it puts them in a tough position. Which do they emphasize? Do they try to rein in inflation at the cost of potentially exacerbating the economic situation? Do they try to rescue the economic situation through cutting rates at the risk of potentially increasing inflation? And they were quite concerned about that trade-off. Post that meeting, we did see the non-farm payrolls numbers, which came out and showed quite clearly that the US labor market is deteriorating. And as a result, we saw a slight shift in tone at the Jackson Hole conference. At the speech last week, Jerome Powell pointed out that it is quite clearly the case that the economic situation has deteriorated. And as a result, there is scope for a change in rates. And the market reception to that was very positive. At the moment, the market is pricing in a close to 90% chance of a cut in September. And in addition to that, the market is pricing in another 3 to 4 rate cuts over the coming year. So in total, 4 to 5 rate cuts over the coming 12 months. And as Jerome Powell was speaking and indicating that the Fed may well shift in September, may well cut, we saw an immediate response to the market. The dollar weakened and the S&P rallied. And that weakness that we've seen comes in addition to quite a bit of weakness we've seen from the dollar over the past 6 months. There's a broad range of currencies that have strengthened quite materially against the dollar over the past 6 months. If we look at the rand, for example, it's about 5% stronger. The Brazilian real is about 5% stronger. The euro is about 10% stronger. Over the past 3 months, it's been a narrower set of currencies that have strengthened against the dollar, but nonetheless, we have seen the dollar weaken quite materially against a broad range of currencies over the past 3 and 6 months. Even so, the dollar is still strong. If you look at the trade-weighted, inflation-adjusted dollar, so you look at the dollar versus all of the other currencies that the US trades against, weighted by the amount of trade that the US does with each of those countries, and you strip out inflation differences, after that exercise, we can see that the dollar is not far off 20-year highs, inflation-adjusted and trade-weighted. The euro is weak, the Japanese yen is weak, the rand is weak, the Brazilian real is weak. There's a range of counter currencies that are quite weak, and the dollar, even after recent moves, remains strong. And it does lead one to suspect that we are likely to see further dollar weakness over the coming year or so. And it is important to recognize that when the dollar has weakened, traditionally we've seen rest of world equities outperform the US. So the prospect of a rate cut in the US, allied with the prospect of further weakness from the US dollar, does suggest that we should be looking outside of the US for opportunities, especially when the US is trading on a forward PE of about 24 times at about a 30% premium to normal, and we can see better opportunities elsewhere. So the broad takeaway, I think, from the latest economic data and from the latest commentaries from the Fed is around caution with regards to the outlook for the US economy. And even should it be the case that the Fed does cut, given valuation, we probably do need to sharpen our focus on opportunities outside of the US. And finally, on South Africa, South African inflation ticked up to 3.5% last month. That was the consensus forecast. We expect that inflation is going to continue to increase, getting to about 4.5% by year end. And that does put the SARB in a difficult position. They're looking for inflation to be at 3%. They expect that this uptick in inflation over the next couple of months will be temporary. We think it's likely to last a bit longer. The SARB's target was for inflation to be at 4.5%. There would still be scope for rate cuts, given that the repo rate is at 7% and we have very high real rates in South Africa relative to peers and relative to history. But given that the SARB appears to be focusing efforts on getting inflation to 3%, there's very limited scope for rate cuts, given that inflation is likely to be 4.5% by year end. And the risk, of course, for the SARB is by shifting the target to 3% without, it would appear, sign-off from the finance minister, they would need to keep real rates higher, so interest rates higher for the interim. And the risk is that it leads to lower growth for South Africa while attempting to bash inflation down to 3%. So we'll have to look out for commentary from the SARB. It's very important. What matters most is the timeline that they're intending to get inflation down to 3%. If they want it to be down to 3% now, then we are going to be looking at higher real rates with potential cost to the SA economy over the near term. If they're looking for inflation to get down to 3% over the medium term, then they may well look through this and there could well be scope for further rate cut or two. But it's too early to say that with any degree of certainty. We do need to get some guidance around the timelines from both the SARB and Treasury. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.